Right now, something big is happening behind the scenes in the global financial system, and most people still don't realize how important this moment is. The banking world and the crypto world are moving closer together faster than ever before, and this time the news is not small. We are talking about a historic decision that could completely reshape how digital assets interact with traditional banking. The banks are already reacting, and to be honest, many of them are not happy about it. That alone should tell you how serious this moment is. Before we break everything down, welcome back to We Are Cosmic, the channel where we talk about the future of finance, cryptocurrency, and the technologies that are quietly reshaping the global economy. If you like staying ahead of major financial shifts and crypto developments, make sure you stay until the end of this video because there is a lot of important information that investors need to understand right now. And one quick thing. If you enjoy staying up to date with the latest crypto and financial updates, go ahead and type X in the comment section. I always enjoy seeing who in the community is actively following these developments. Also, a big thank you to everyone who supports the channel by liking and subscribing. Your support helps this community continue to grow, and it allows us to keep bringing you the latest insights into the digital asset space. Now let's talk about what just happened. Breaking news has just come out involving the banking sector and the cryptocurrency industry, and it revolves around something called a Federal Reserve Master Account. This may sound technical, but in reality, it is extremely important because it determines which institutions are allowed to directly connect to the U.S. Federal Reserve's payment system. For many years, only traditional banks had this level of access. That meant if a company in the crypto space wanted to interact with the Federal Reserve's payment rails, they usually had to go through traditional banks as intermediaries. In other words, the old financial system controlled the gateway. But that situation is starting to change. A major crypto institution has now received approval for a Federal Reserve Master Account. This is a massive step because it allows that crypto-focused institution to connect directly to the Federal Reserve's financial infrastructure. And when something like this happens, it signals that digital assets are slowly being integrated into the traditional financial system. Of course, not everyone is celebrating. Many banks are openly pushing back against this decision. Some banking organizations are arguing that allowing crypto institutions into the Federal Reserve System could introduce risks to the traditional banking network. Others believe it could disrupt the long-standing financial structure that has existed for decades. But here is the key point that investors need to understand. Whenever an established industry starts pushing back this strongly, it usually means that something significant is changing. Traditional banks are realizing that crypto companies are no longer operating completely outside the system. Instead, they are beginning to move inside the same financial infrastructure that major institutions have used for years. And once that door opens, the entire financial landscape can begin to evolve very quickly. We are going to break down exactly what this new development means for the banking sector, what it means for cryptocurrency, how it could impact major blockchain projects, and why some analysts believe this moment could be the beginning of a much larger transformation in the financial world. We are also going to discuss new developments involving payment platforms built on blockchain technology, growing institutional interest, ETF activity, and some major global macro events that are also influencing the crypto market. The main issue revolves around something called a Federal Reserve Master Account. In simple terms, this account allows an institution to directly access the Federal Reserve's payment system, also known as FedWire. This is the core infrastructure that banks use every single day to move massive amounts of money across the financial system. For decades, access to this system was limited mostly to traditional banks that are heavily regulated and insured. This structure allowed banks to control the flow of money through the financial system. If a company wanted to move large amounts of funds quickly and securely, it almost always had to go through a traditional bank. But now we are starting to see a shift. A crypto-focused institution has officially received approval for a Federal Reserve Master Account. This means that the company can now operate directly on the same payment rails used by some of the biggest financial institutions in the world. We are talking about the same infrastructure used by major Wall Street banks. This is exactly why the banking industry is reacting so strongly. Several banking organizations have already expressed serious concerns about this decision. One of the groups speaking out is the Bank Policy Institute, which represents many large banks in the United States. According to their statement, they believe the Federal Reserve rushed this decision and did not fully follow the normal process of public consultation before making such an important change. Their argument is that allowing new types of institutions into the payment system could affect the stability of the existing banking structure. They claim that these types of changes should be carefully reviewed before being implemented. Another organization that raised concerns is the Independent Community Bankers Association, which represents thousands of smaller community banks across the United States. Their concern is slightly different, but still very important. They argue that granting master account access to non-bank entities, especially crypto institutions, could introduce potential risks into the banking system. Traditionally, only insured deposit institutions had this level of access. Expanding that access to new types of financial companies could change how the system operates. But from the perspective of the crypto industry, this development represents something very different. For many years, crypto companies were treated as outsiders by the traditional financial system. Many banks refused to work with crypto businesses, and some regulators placed heavy restrictions on how digital asset companies could operate. Because of that, many crypto companies had to rely on limited banking partnerships or complex workarounds just to function within the financial system. Now that situation is slowly changing. Receiving a Federal Reserve master account means that crypto institutions are beginning to gain direct recognition inside the financial infrastructure itself. This is a major step toward integrating digital assets into the global financial system. And here is where things start getting even more interesting. Once one institution receives approval, it often creates a pathway for others to follow. Financial systems tend to move in phases. First comes the initial approval, then comes broader acceptance. Many analysts believe we are currently witnessing the beginning of that process. The reaction from banks also tells us something important. When established financial institutions begin pushing back this strongly, it usually means they recognize that the competitive landscape may be changing. Crypto companies gaining direct access to financial infrastructure could reduce the dependency on traditional banks. And if digital asset platforms can operate more independently, it could open the door for new financial services that operate faster, more efficiently, and with lower costs. But the story doesn't stop there, because some analysts now believe that another major player in the crypto space could be next in line for this level of financial integration. And if that happens, it could accelerate the transformation of the global financial system even further. Now that we understand why the banking sector is reacting so strongly to this decision, the next question many analysts are asking is simple. Who could be next to gain this level of access to the financial system? One name that keeps coming up in this discussion is Ripple. For those who have been following the crypto industry for a while, this might not be surprising. Ripple has spent years building relationships with banks, financial institutions, and regulators around the world. Unlike many crypto companies that focused mainly on trading or decentralized applications, Ripple positioned itself as a technology provider for global payments and financial infrastructure. Because of that strategy, Ripple has always been closely connected to the traditional financial system. Recently, some analysts started discussing a theory about how the latest development with crypto institutions gaining access to the Federal Reserve System could also impact Ripple. One of the key reasons behind this speculation is the fact that Ripple has already taken an important step toward deeper financial integration. Last year, Ripple secured a national trust bank charter in the United States. While this may sound like a technical detail, it actually plays a very important role in how financial companies operate. A charter like this allows a company to function more like a regulated financial institution rather than just a technology company. In simple terms, it gives the company the legal framework needed to operate at a higher level within the financial system. This is why some analysts believe that Ripple may eventually pursue direct access to the Federal Reserve's payment infrastructure as well. If that happens, it would allow Ripple's financial products to operate on a much larger scale. One product that many people are watching closely is RLUSD, Ripple's stablecoin project. Stablecoins are digital assets that are designed to maintain a stable value, usually tied to a traditional currency like the US dollar. The idea behind RLUSD is to provide a digital dollar that can move quickly and efficiently across blockchain networks while still maintaining stability. If Ripple were able to connect this system directly to Federal Reserve payment rails, it could allow stablecoin transactions to operate at the same scale as traditional banking transfers. That kind of integration would be a major step toward merging traditional finance with blockchain technology. But there is another factor that could also accelerate these developments: regulation. In Washington, lawmakers have been working on legislation aimed at creating clearer rules for digital assets. One proposal that has been gaining attention is known as the Clarity Act. The goal of this legislation is to provide clearer guidelines on how cryptocurrencies should be regulated in the United States. If regulatory clarity improves, it could encourage more financial institutions and government agencies to work directly with blockchain-based companies. Many experts believe that clearer rules will make it easier for crypto companies to integrate into the traditional financial system without facing constant legal uncertainty. And this is where the bigger picture starts to come into focus. For years, the crypto industry and the traditional banking industry have often been viewed as competitors. But what we are starting to see now is the early stage of integration rather than competition. Instead of replacing the existing financial system overnight, blockchain technology is gradually being woven into the infrastructure that already exists. The approval of master accounts for crypto institutions could be one of the first major steps in that direction. And if companies like Ripple eventually gain similar access, it could significantly accelerate the modernization of global financial networks. But financial integration is not only happening in the United States. At the same time, we are seeing new blockchain payment systems being built in other parts of the world as well. And one of the most interesting developments recently has come from Asia, where a new payment platform built on blockchain technology is already beginning to transform how international transactions work. While the US is making waves with Federal Reserve master accounts and regulatory developments, the adoption of blockchain technology is becoming a truly global phenomenon. The story isn't just about Ripple or one institution in America. The trend we are seeing is much bigger. The world is starting to build payment systems on blockchain that are faster, more efficient, and far more transparent than traditional systems. One of the most exciting recent developments comes from Japan, where a new payment platform has been launched on the XRP ledger, XRP LPL. This platform is designed for trade finance and global payments and is using blockchain to streamline processes that traditionally took several days to settle. Normally, international trade payments involve multiple intermediaries, banks, escrow services, and regulatory checks. Each step adds time, cost, and complexity. But with this new blockchain-based platform, settlements happen almost immediately once the agreed conditions are fulfilled. By using multi-party decentralized consensus and smart escrow mechanisms, the system removes the friction that has historically slowed down global transactions. What's particularly important is that the platform is leveraging smart escrows. These allow transactions to be conditional and trustless, meaning that funds are only released when certain predefined conditions are met. This reduces counterparty risk, the risk that the other party may not fulfill their part of the agreement, which is one of the biggest challenges in international trade. Analysts are pointing out that the choice of XRP Ledger is not accidental. Ripple's technology has proven to be fast, scalable, and cost-efficient, making it ideal for large-scale payment systems. And even more importantly, XRP Ledger is already integrated with several financial institutions globally, which makes adoption smoother compared to newer, untested blockchains. This Japanese development is a great example of how blockchain is no longer experimental. Businesses and governments are beginning to trust decentralized networks for real-world financial operations, which is a major milestone for the entire crypto ecosystem. At the same time, these global innovations complement what's happening in the United States. As crypto companies gain Fed master account access and regulatory clarity improves through initiatives like the Clarity Act, the combination of domestic acceptance and international adoption sets the stage for a true 21st century financial system. Now let's connect this to broader macroeconomic trends, because these developments aren't happening in isolation. Recent global events are shaping investor sentiment and influencing crypto adoption worldwide. For example, the situation in the Middle East is impacting markets, oil prices, and geopolitical risks. Countries are coordinating military and financial strategies, which in turn affects both fiat and digital assets. Investors are closely watching these developments to understand how they could influence liquidity and capital flows in the global system. This is where crypto, particularly XRP, is starting to show its unique advantage. Unlike traditional banks, blockchain networks can operate globally without being tied to any single country or political framework. That means when geopolitical uncertainty hits, blockchain-based financial systems can continue to operate with minimal disruption, In addition to geopolitical factors, institutional adoption is also increasing. We are seeing ETF inflows and trading volumes rise for major crypto products like XRP. Institutional investors are gradually recognizing the potential of digital assets not just as speculative tools, but as real operational financial infrastructure. All these factors together, domestic regulatory shifts, international adoption, macroeconomic pressures, and institutional interest, are creating what many analysts call a perfect storm for the digital asset space. This is not just about price movement, it's about structural change in how the world moves money. Now that we've explored the regulatory and global adoption side, it's time to focus on XRP itself and what's happening in the markets right now. Understanding XRP's position is crucial because it's not just another cryptocurrency. It's increasingly becoming a bridge between traditional finance and blockchain networks. One of the first things to note is recent market movements. XRP has experienced a relief rally with its price jumping roughly 7% in a single session. This isn't just random volatility, it reflects investor optimism in response to several key developments. First, the progress in Federal Reserve master account approvals has highlighted that digital asset companies are gaining access to the traditional financial infrastructure. Second, global adoption efforts, like the new Japanese trade finance platform on XRP Ledger, have shown that XRP isn't only theoretical, it's being used in real-world financial applications. Institutional interest is also increasing significantly. Let's break down the recent ETF inflows as an example. Franklin Templeton's XRP ETF reported almost 9.5 million in new inflows. While 21 shares added over 8 million, Grayscale came in with about 5 million, and other ETFs like Canary and Osprey brought in additional inflows. These numbers are important because they show that big financial institutions are actively investing in XRP, not just retail traders. Institutional involvement often signals longer-term confidence in a crypto asset's underlying utility and stability. Why is this institutional activity particularly significant for XRP? Unlike many cryptocurrencies that are primarily traded for speculation, XRP is designed for real-world settlement and payments. Its integration into new financial platforms, combined with regulatory clarity, means that XRP can be used as a transactional bridge asset between banks, financial institutions, and even cross-border settlements. Analysts are also noting the growing importance of custody solutions for institutional investors. Digital assets require secure, regulated custody mechanisms, especially for large sums. Platforms offering institutional-grade custody are helping professional investors enter the market confidently, which further increases XRP's adoption potential. Another factor to watch is the impact of macroeconomic events. Global developments, such as geopolitical tensions in the Middle East and shifts in oil markets, are influencing investor sentiment. Despite these uncertainties, XRP has shown resilience as its blockchain technology allows fast global transactions independent of traditional banking bottlenecks. Investors are starting to see XRP not just as a speculative asset, but as a practical tool for financial operations during times of global uncertainty. Moreover, XRP's positioning is strengthened by the pro-crypto administration in the US, which is signaling openness toward integrating digital assets into the broader financial system. High-level nominations at the Federal Reserve, including officials with pro-crypto or Bitcoin-friendly reputations, are also shaping investor expectations. These appointments indicate that digital asset infrastructure could see more official recognition and integration in the near future. So why should this matter to everyday investors? Because XRP is not only benefiting from short-term market rallies, but is also positioned for long-term structural adoption. When a crypto asset gains both real-world utility and institutional backing, it's a signal that the asset is moving beyond speculation toward becoming a core part of the financial ecosystem. Looking forward, XRP's potential to integrate with traditional finance, its growing role in international payment platforms, and institutional interest all point toward a broader systemic shift in the crypto and banking relationship. This makes XRP an important asset to watch in the coming months, not just for trading opportunities, but for understanding the future of finance itself. Now that we've explored the regulatory shifts, global adoption, market activity, and XRP's role, it's time to step back and look at the big picture. What does all of this mean for investors, for the crypto industry, and for the future of finance. First, let's talk about the future of financial integration. What we are witnessing right now isn't just a one-off event, it's part of a broader trend where digital assets and traditional banking systems are starting to merge. The approval of Federal Reserve master accounts for crypto institutions, coupled with Ripple's strategic positioning and international adoption efforts, shows that digital assets are increasingly recognized as legitimate infrastructure for global finance. Think about it like this. For years, crypto was seen primarily as speculative assets. Most investors bought cryptocurrencies hoping for price appreciation. But now, cryptocurrencies like XRP are transitioning into utility assets that can settle transactions at scale, reduce friction in international payments, and operate in ways traditional banks cannot. This shift from speculation to utility is what separates the pioneers from the short-term traders. For investors, this means mindset is critical. If you are looking for short-term gains only, volatility may feel like risk. But if you understand the long-term structural changes in the financial system, these developments highlight opportunities to participate in a transformative shift in money and payments. XRP, in particular, is at the center of these changes because of its real-world adoption, regulatory alignment, and institutional support. Another factor to consider is global adoption momentum. Platforms like the Japanese trade finance system built on XRP Ledger demonstrate that digital assets are not just experimental. They are solving real problems that banks and traditional financial systems have struggled with for decades. Faster settlements, reduced counterparty risk, and trustless escrow solutions are not just technical innovations. They are directly impacting how money moves around the world. Additionally, institutional interest is continuing to grow. ETFs, custody solutions, and investments by professional financial firms signal that digital assets are moving from fringe technology to mainstream financial infrastructure. The significance of ETF inflows cannot be overstated. They reflect confidence that these assets have lasting value and practical use beyond speculation. Macro factors also play a role. Geopolitical developments, conflicts, and economic shifts influence both fiat and digital markets. XRP and blockchain networks have a unique advantage here because they operate independently of borders, allowing transactions to continue even when traditional systems face disruptions. This resilience positions crypto assets as not just alternative investments, but essential components of a future-ready financial system. So what should investors do? The first step is awareness. Understand the underlying shifts, not just price movements. Recognize that when crypto networks gain access to banking infrastructure, or when countries adopt blockchain-based payments, these are structural changes that will shape the market for years. The second step is preparedness. Ensure that your holdings are secure with institutional-grade custody solutions, follow regulatory developments like the Clarity Act, and stay updated on international adoption trends. Being informed allows you to make decisions with a strategic, long-term perspective rather than reacting to short-term hype. Finally, stay engaged with the community. Channels like We Are Cosmic exist to provide insights, break down complex topics, and help investors navigate this rapidly evolving space. The digital asset ecosystem is moving fast, and being informed is your best tool for staying ahead. In conclusion, the integration of crypto into the traditional financial system marks the beginning of a new era in finance. XRP is at the forefront of this transformation, bridging old and new systems, enabling faster, more efficient global payments, and gaining institutional recognition along the way. Investors who understand these developments, remain patient, and focus on structural trends rather than short-term volatility will be best positioned to benefit from what could be one of the most significant financial shifts of our generation. So stay curious, stay informed, and stay ready. The future of finance is here, and it's cosmic.